What an exciting time on the markets. We've just completed the best quarter that we've seen for the Australian share market since September 2009. But now we've run into a whole lot of macro risks. The numbers out of China weaker than expected. We're seeing some problems in terms of the Italian government and, of course, over in the US, looking at the US shutdown as well as arguments, negotiations around the debt ceiling. So what does this mean for your portfolio and for your shares? Let's ask our panelists. I mean, just when we thought things were getting better, it feels like we're just going around and around in circles, back to the US debt ceiling, another US shutdown. Really, David, when you see things like this, does it change the way you invest or how you view the market? Do you take some money off the table? What do you do?
Look, Julie, let's not lose context. The markets are up 30 percentage points since June last year. They've rallied from about 4,000. They got up all the way up to 5,300 late last week, which is a 5-year high. They've come back a little bit, but still up 30% excluding dividends. So it's been an almighty 15 months. And I think prospects with very, very low interest rates, a lot of cash on the sidelines, are still exceptional. And as you said, we've just had a really good quarter in terms of returns. And the real question now is to what extent this debt ceiling situation drags on. Will it be a long time or a short time?
Okay. Do you look at this as an opportunity to increase your weighting into shares? Or?
I think you mentioned on the Switzer show just 10 minutes ago that in the September quarter 2011, the Dow did fall about 20 percentage points. So that was at the time when S&P downgraded the US paper from AAA to A. And obviously that won't happen again, but the question is, the Dow's obviously off from sort of, high-ish 15,000s to low-ish 15,000s. And the real question is, will we have a serious pullback in America which influences our market? And only time will tell. We don't know. But the fact of the matter is that it will create opportunities.
And we've got Les on the line from Adelaide. Les, welcome to the program. What's your question tonight for our panel?
Hi, Julia, and hello to Gary and David. Look, two companies I'm interested in are Ausdrill. They've had a sharp fall after going ex-dividend a couple of days ago, and I'm wondering if that is a good business and worth getting in at their price of around $1.47 that they're at now. And the other one is Treasury Wine Estates, who've had their dramas. I mean, as little as 2 months ago, they were around about $6.30, and it was said that they were going to be one of the major beneficiaries of a weaker Aussie dollar. But of course now they've dropped down to around $4.54, something like that, and I'm wondering if it's a good business or if it's still a bit risky.
I think some good questions coming through from this. I mean, both companies should be benefiting from a lower Aussie dollar. Ausdrill has been through a lot over the past 12 months, but it was one of the best performing stocks over the last quarter. The stock was up 85%. I think only Billabong beat it in the ASX 200 with a gain of 150% during the quarter. But over the past year, it's seen a loss. What do you think, David, of Ausdrill?
Well, Julia, Ausdrill, well, Les, just on Ausdrill, market capitalisation $459 million. Reasonable net debt to equity, about 56%, so that's not sort of, exorbitant. The issue we have, despite the $1.47 share price and the fact that our valuation is neatly above that, is that its prospects in terms of its return on equity are in fact declining. So its historical return on equity, a very reasonable 14%. But we see that declining over the next couple of years to sub 10%, and we really don't like stocks whose prospects aren't exciting. Just going on to Treasury Group, I mean, it's a $2.9 billion company. It actually has quite low debt to equity at about 7%, but its return on equity is appalling. It's about 2%. Now, there are forecasts that will grow to maybe 4%, maybe 6% over a period of time, but again, we do not like businesses that have such a appallingly low return on equity. So, our view is we would probably own neither stock, despite the fact that Ausdrill's valuation is neatly above its share price.
And David, what would it take for you to get interested in a company like Treasury Wine?
We wouldn't buy it, full stop. Just not the quality that we're looking for in terms of return on equity and prospects.
And is it because do you stay away from turnaround stories?
No. It's Montgomery focuses on businesses that have very high return on equity, excellent balance sheets and good prospects. That's the first half of the equation. The second half of the equation is the share price must be selling at a discount to our assessment of the intrinsic value. So if you get that matrix lined up, then you'll do much better than the market over a long period of time.
Let's go to our next caller. We've got David on the line from Canberra. David, welcome to the show. What's your question tonight?
I just had a question on McMillan Shakespeare for David. I was just wondering what you think of it sort of going forward, whether you think it'll trade on a sort of a lower PE ratio, and what do you have an exit strategy for it, or do you plan to sort of hold it for the long term?
Okay, so David, McMillan Shakespeare.
Okay, our valuation on McMillan Shakespeare is about $13.50, David. So if the share price on today's information traded up towards $14 or above, we would certainly look to lighten the load on that one. I mean, as you may know from past shows, we bought that very aggressively when it came out of suspension during the electioneering debate at $7, and it was very clear to us over time that as the coalition was becoming hot favourites, that they weren't going to change the fringe benefits tax. So that reinforced our valuation of about $13.50. So at $7, we just thought it was an exceptional buying opportunity on a risk-adjusted basis. At $14, it's a completely different story. It's no longer value for money for us.
Okay, so not interested in McMillan Shakespeare.
No, interested, Julia.
Interested, but not at this price.
No, at this price interested, because it's $11.50.
Okay.
But our valuation is closer to $14, so that's at the level we start heading out the door.
Okay, so interested in McMillan Shakespeare at these levels?
Yeah.
I mean, traditionally it was very much a defensive stock, but given the volatility that we've seen, do you apply a discount to McMillan Shakespeare? Or?
I know, as the coalition government settles down, the whole fringe benefits tax changes will recede into the back of everyone's memory, and life will move on.
Okay.
It's just that this half year, earnings will be quite negatively affected. And but if you look at, say, for example, fiscal 15, it'll be business back to normal.
Okay, start stopwatch round 2. This time, Dave, you have 30 seconds to tell us the stock you're watching and why. Your time starts. Now.
Today I'm going to talk to you about Onthehouse, OTH. It's a online real estate content and service platform. It's a very small company, capitalised at $57 million. It has $4 million in the bank. It resembles a company called Zillow in the US. Now, I know Australia only has 7% of the US population. It's probably 2 or 3 years behind Zillow's future, but we actually quite like the prospects over the medium to longer term. Onthehouse, OTH. As I say, very exciting sort of medium to longer term outlook.
And we've got our next caller on the line. We've got John from Wagga Wagga. John, welcome. What's your question tonight?
Hi, Julia. I'd just like to ask the panel on a 6 to 12 month outlook on the stock NWH and a 6 month outlook on QBE.
Okay, so 2 stocks once again that have been doing it pretty tough over the last 52 weeks. It's been quite a volatile ride. NRW Holdings, NWH is a stock code. Let's start off with that one. Lumped into the mining services area. Once again over the last quarter, very strong recovery. Can it continue? What do you think, David?
Look, John, I think this is a very difficult call. As Julia says, you've had a really good rally in the last 3 months. But the problem, and the stock definitely looks cheap versus their intrinsic value. In fact, it looks very cheap versus intrinsic value. The problem is the prospects over the next sort of 24 to 36 months are extremely up in the air, and there's a lot of forecasters that are calling a fairly serious deterioration in the spend that's going to go on in NRW's space. So that's particularly the iron ore related type spend, and obviously you've got the three big boys, and BHP, Rio, and Fortescue who are expanding. Roy Hill may get the go ahead, but if you don't win those tenders and you come off second best, you've got a very large staff and a lot of yellow trucks, and you don't have quite as much work as you used to have. So the prospects there are very much up in the air, despite the stock looking reasonably cheap.
And we've got Matt on the line from Melbourne. Matt, welcome. What's your question tonight?
Hi, thanks for taking my call.
You're welcome.
Question tonight is in regards to Jet Education. I previously owned the stock, but actually just sold out recently. I thought it was a little bit too expensive, 35 times earnings. But obviously the announcement on Friday made me take notice again. The acquisition of 29 new centres, it was pretty aggressive considering they tended to pick up 2 or 3 at a time in the past.
Sure.
Just based on the EBIT guidance they put out with the announcement, and obviously dilution in the capital raising, looks like maybe full year 14 EPS around 13 to 14 cents a share. Just wondering what David felt about it. I'm pretty sure the Montgomery boys followed the stock.
Yeah.
Is he comfortable with the large amount of goodwill on the balance sheet there, and does he still see some value there?
It's probably a great question for David. I mean, the stock's up 158%. Would you still be buying it?
We still are buying it, Julia. We actually participated in the capital raising that took place yesterday. As you mentioned earlier, Matt, they've just raised about $82 million, and I think that capital raising was in fact something like 6 times oversubscribed. They had demand for approximately $480 million for that placement. The share price is, roughly $3.30. Our valuation is close to $4. I, in fact, spoke on this stock at Your Money, Your Call last time I was on this show a couple of weeks ago. It's got a very good balance sheet, but most importantly, it's very, very, very disciplined management. And when they acquire nurseries and kindergartens and the like, they're not paying a cent more than 4 times EBIT, and they are getting some small synergistic benefits. But they've been very aggressive in that every time they acquire a lot of centres, they then have a capital raising, and they've done it 2 or 3 of them this calendar year in this roll-up phase. And what it means is that their balance sheet's always in excellent order. In fact, I would actually argue that they're probably having too many capital raisings, because I don't think their capital management. I think their capital management could be infinitely better. But despite all that, our valuation on the stock is close to $4.